Hello all, I'm Connor Guile and welcome back. In this video, we're going to compare entrepreneurship through acquisition with two other major investment models, that being private equity and venture capital. To keep things simple, we'll break this down into four key categories: business characteristics, investment dynamics, operational involvement, and then growth and exit strategies. By the end of the video, you'll have a clear understanding of how these models compare, which risk profiles they fit, and why ETA is uniquely positioned as a lower risk, hands-on approach to business ownership. Let's get started. Entrepreneurship through acquisition, or ETA, is a model where entrepreneurs acquire established, cash flow positive businesses to take over and grow. It offers a hands-on, lower risk path to business ownership focused on stability and long-term success. Let's start with some business characteristics of ETA. This model targets established businesses with proven operations, stable revenue streams, and a solid customer base. Unlike other approaches, ETA focuses on stability and legacy, ensuring the business remains strong while introducing thoughtful improvements that honor its history and culture. Next, let's talk about investment dynamics. ETA operates with a low risk profile thanks to its focus on businesses with predictable cash flows and minimal volatility. It uses a mix of equity and debt financing, making acquisitions financially accessible for first-time entrepreneurs. The return expectations are steady and sustainable, ideal for those looking for long-term financial stability rather than high risk and quick gains. Now let's move on to operational involvement. Entrepreneurs in ETA take full control of the business, managing its day-to-day operations and driving growth directly. At the same time, investors act as mentors and partners, offering valuable guidance, expertise, and networks to support the entrepreneur's success. Finally, let's look at growth and exit strategies. ETA focuses on incremental growth, building on the existing strengths of the business through operational improvements and strategic enhancements. It's designed for long-term ownership, allowing entrepreneurs to grow at a sustainable pace and scale thoughtfully. When it's time to exit, ETA provides flexible options, including long-term ownership or a sale to a strategic buyer. I like to think of ETA as buying a stable house in a good neighborhood with existing tenants. Instead of using maybe a 10 or 20% down payment, however, you're using up to 50% equity and 50% debt to finance this purchase, and you're looking to maintain and improve it gradually and hold it for the long term and sell it when the mortgage is fully paid off. Now, private equity, or PE, is an investment model where firms acquired established companies to improve their operations and profitability before selling them at an even higher valuation. It's a strategy focused on financial optimization and high returns, often through strategic restructuring and operational efficiency. Some business characteristics of private equity include that their model targets mature businesses in growth or mature industries with opportunities for value creation. Unlike ETA, PE focuses on rapidly scaling and increasing profitability, often through operational overhauls or any cost-cutting measures. This often includes layoffs. Next, to the investment dynamics. PE operates with a high to moderate risk profile, relying heavily on debt financing to really pick up those returns. This leveraged approach is looking to garner substantial returns within a defined time frame, typically 5 to 7 years. Now, let's move on to operational involvement. Private equity firms maintain strategic oversight, working closely with management teams to execute their plans. Unlike ETA, where entrepreneurs are hands-on, private equity investors focus very closely on the financials of the business and provide guidance from more of a high-level perspective. Now to look at growth and exit strategies. Private equity emphasizes aggressive scaling, targeting high-value transformations to rapidly increase that company's worth. Exit strategies typically involve sales to strategic buyers or other private equity firms, or even an IPO, an initial public offering. This typically has a medium time frame of about 5 to 7 years. Now going back to that house example. For private equity, I think of this as buying a house in need of a renovation and using the maximum amount of debt possible to purchase that house. Maybe it's a standalone house that needs a lot of renovations. You look to knock it down and build a duplex on top of it to help maximize that revenue. The final model we'll look at today is venture capital, or VC for short. It's an investment model where firms or individuals fund early stage companies with high growth potential. It focuses on innovation and disruption, supporting startups with capital in exchange for equity, often in unproven or emerging markets. Some business characteristics of VC includes targeting those early stage startups in dynamic industries, something like technology, healthcare, or renewable energy are good examples of this. These companies often operate with unproven business models, but exhibit significant potential for this real growth. For the investment dynamics, VC operates with a high risk, high reward profile using pure equity financing to fund these startups. The returns often follow what's called a power law, where one breakout success offsets the losses of all of the other investments. When looking at operational involvement, VC investors take a limited involvement approach, often providing guidance, mentorship, and access to networks rather than directly managing the company. They focus on empowering the founders to scale quickly and seize any market opportunities. Finally, with growth and exit strategies, VC emphasizes exponential scaling, leveraging fast-growing markets to maximize those company valuations. Exit strategies typically include IPOs or acquisitions by a larger firm, aiming for significant payoffs to justify the high risks involved. Going back to the housing example, this is like buying 10 studio apartments in emerging areas, expecting for one breakout success. You fund them with pure equity, waiting for the market to skyrocket for that one apartment, and hope its gains offsets the other's costs. Now, to be fair, this isn't a perfect analogy for venture capital, as finding the right entrepreneur or the right product are two major portions of venture capital. But this is specifically a good example for VC firms that focus on a trendy industry, hoping to ride the wave. Just to sum this all up, this slide provides a high-level overview of the three different investment models across the four critical categories. ETA is built on stability and legacy, emphasizing full control and steady returns through incremental growth. PE focuses on optimizing mature businesses for financial gains, leveraging debt, and strategic oversight. VC targets startups that drive exponential innovation with high risk and variance, but offering potential for substantial returns. Each model highlights unique investment philosophies, operational approaches, and growth strategies tailored to specific risk profiles and market opportunities. Going back to the housing analogy, ETA is akin to buying a stable home with tenants, focusing on gradual improvements and long-term ownership. Private equity resembles acquiring a house in need of renovation, quickly optimizing it for a higher return. Venture capital is comparable to investing in multiple studio apartments, relying on one significant success to offset the broader risks. And that's it. I hope by understanding these differences, you can better identify which business model aligns with your personal goals and your risk tolerance. Thanks for watching.